and welcome to Ramp Up to Retirement with your host, Dan Reese. Dan, I love this topic today. More importantly, or just as importantly, I love how you organized your conversation about this topic today. So I can't wait to get into it. How are you?
I'm great. Yeah, this is a really, I think, good topic for a lot of reasons. But as we get into it, the hope is that it really helps people do better with their money. So that's the end game.
It is, and the impetus for this is the fact that, as we were talking about, politics can be really polarizing, and because it can be polarizing, depending on which polar you sit on, you can view things differently. And the markets can offer up a reflection of all of that polarity, if you will. And we've certainly seen a lot of volatility in the markets these days. So political emotions and investor behavior, Dan, quite something to watch.
Yeah. I mean, I think the thing is like we always want to think that we're really logical, like, oh, I only make logical decisions. That emotion stuff, that's for other people, right?
Yeah. Somebody else, not me.
Yeah, it's always someone else. And the reality is no, we're emotional. And so we can't really split that apart from who we are. And so unfortunately, guess what? That sucks us in. And in politics are one of the most emotional, topics that exist in the world, right?
Yes.
Because we feel very strongly, many of us, on, what we believe. And so, like it or not, that ties into our investment decisions. And
it does.
That's probably a bad thing.
Yeah, I would say so. But to your point, I always laugh because I spent 30 years being a business and financial news reporter. And I laughed anytime anybody said markets are rational, because I'm like, if you looked at the market today.
Right. Yeah.
And that's what we're getting right now. So how do we deal with that? And what do we do about it?
Yeah. The first thing is like, I would say you're right. Like short-term markets are crazy, right? And if you watch them every day, you will make yourself crazy.
Yes.
Long-term markets are pretty consistent. You know what I mean? If you take long periods of time, markets tend to be long-term average, you hear most commonly like S&P 500 around 10%, right? And it'll change from time to time. But they are pretty rational because the actual market returns are based on companies making money, in profits and in basically things of that nature, which over time are pretty consistent. And that's what's great about, our economy, right? Is there's an incentive to make profits. Companies will find ways to do that. And if we are patient and we take part in owning some of those companies over long periods of time, we tend to do quite well, right?
Yeah, but patience is the key there, Dan. Patience is the key, because I know a lot of people who, when their candidate, it doesn't matter who their candidate is, has lost an election, they do a knee-jerk, oh my God, I got to get out of the markets. And most of the time, that's not a good decision.
Right. And that's kind of what we want to talk about today, is that, like it or not, that happens all the time. And we've done a lot of research that shows that data's out there. And we want to kind of dig into that a little bit, because the goal really is to help you understand that whoever's in office is not the market, right? It's not the law. It's not all these companies. They're making their decisions. Companies are making their decisions based on trying to make money. And regardless of who's in office over time, guess what? Returns are pretty much the same. There's a very small difference between like a Democratic president, a Republican president. It's just not significant, right?
Yes.
But a lot of times, and where we get into trouble is we kind of want to believe it is different. You know what I mean? We want to believe, hey, my guy or my girl's in office, everything's going to be great.
Yep.
Or what's the other side of the coin? My person's not in office, so it's probably going to be terrible.
It's going to be bad. Things are horrible. Everything's going to go wrong.
Yeah.
You must see that a lot, though, Dan. You must see that a lot, because you deal with clients on a day-to-day basis. So you must have tons of stories in regards to exactly what we're talking about.
Oh, yeah. It's really common, and we really try hard to keep people invested. So the key to this, which we're going to get into, is, sticking to a plan. But a lot of it is trying to walk people back off that ledge, because it's really emotional. And it's really easy to get sucked into that. And that's what we want to try to avoid. And so, a couple of real examples, like, it doesn't seem like that long ago. I think of the 2016 election. Must mean I'm getting older, right? Because it doesn't seem that long ago. But if you look at that, I don't know if you remember, I was staying up watching the election, of course, because of my job. I kind of was watching the markets, the futures, right?
Mm-hmm.
And you saw when it became evident that Trump was going to beat Hillary Clinton, the markets went really negative. Like, I think they were down, like the Dow might have been down 1,000 points or something. It was significant, right? And then, of course, by morning, it kind of had settled out a little bit, right? But with that being said, when Trump, was announced the winner and everything, many Republicans were very excited, and very bullish about the future, right? And so many of them actually made adjustments to their portfolios that they wanted to be more aggressive, right? And on the flip side, guess the other half of the population was scared to death, right? And so what did they want to do? They wanted to back off, and they wanted to have less money in the market and less stock exposure and all that. Now, I will tell you, neither of those decisions is probably right. Like, honestly, like it really shouldn't affect your long-term allocation and structure. But again, we're human beings, right? And that's really what happens, because when you're more optimistic, you tend to brush off like the volatility more, with this idea it's going to be good. And when you're more pessimistic, that volatility affects you more, because your underlying belief is it's going to be bad, right?
Yep.
And so, you look at that in 16, then the next time it happened was COVID, right? Yep. So, if we fast forward a few years, COVID hits, it's awful, right? We have a massive, massive drop in the market very quickly, right? And everybody's affected that has stocks. And so what was interesting, and research actually shows this, because there's all this data out there about trading and allocation and retirement accounts and things like that. Well, people that tended to lean Republican basically actually stayed the course and even got a little more aggressive and traded more, because they believed Trump. Like, they believed what he was saying, that it was going to be okay and like everything was going to be fine, right? And guess what? They have a term, I actually looked it up. It's called partisan perceptual screen. So what that is like behavioral psychologists come up with this. And so what it is that we tend to, absorb that information based on, kind of our partisanship, and so like people that were kind of pro-Trump at that point believed him and was like, oh, it's going to be fine. And they actually, stayed the course or got more aggressive. People, the opposite, said the world's ending, I got to get out. And a lot of people sold positions and, basically pulled out of the market. And what do we know? Because, what do they say? Hindsight's 20/20.
Yep.
Markets recovered like they always do. Had nothing to do with Trump being there. It had to do with that's what markets do.
So I'm curious, Dan, did you have to talk people? I don't mean this literally, I'm just using it figuratively. Did you have to talk people off the edge? You must have had clients who were like, you had to sit down and say, we have a plan.
Yeah, absolutely.
How do you deal with that? I mean, I don't know.
Yeah, no, I mean, absolutely. They're just good conversations. And I think a lot of it is that people need to get it out. They need to get that frustration out. We've talked before, and I think we talked maybe before this episode about this idea, like, Abraham Lincoln would get upset at someone or about something, and he'd write a letter. I believe it was him that would do that. And he would never send it. He would just write it and get it out, because he needed to get that outlet to let that frustration and those feelings out, right?
Right.
And then I think once you allow people to do that, then at that point you can kind of back up a little bit and say, all right, let's look at this, try to look at it a little bit more logically and less emotionally. And what do we think? Where do we think the markets are going to be 5 years from now? And what most people will agree, well, it's almost like begrudgingly, they're probably going to be higher, right?
Well, they're going to be higher, yeah.
Yeah, and deep down, we all know that markets over time have a lot of volatility, but over time they grow. And so, we talk through that, and we talk about, hey, if you're relying on your portfolio or are going to be in the near future, how much money do you have in safer investments that you can rely on while this stock market craziness works its way out? And so you try to think of it a little bit more, logically, and say, okay, you know what, I am okay. This stuff will work itself out. And I think it was my dad told me when I was a kid, things are never as good as you think or as bad as you think. And I think that's a really good lesson when it comes to money, because markets are never as good or as bad as you think. So, that's a lot of it is you just got to work through it.
Do you lay out the consequences for them? Or, I'm kind of wondering about the practical thing. It's like you sit them down and go, look, what do you tell them? Do you say, I'm guessing some of them probably need to be reminded that long-term things, as you just mentioned, usually work out and they're usually typically higher. And, they don't want to miss any kind of opportunity.
Yeah.
Is that what walk me through that? If I'm your client, I'm like, the world is ending, Dan. Things are crazy. Look at the markets. Everything's nuts. I don't know, man. I don't know if I have the stomach for this. I don't know what to do. Give me some advice.
Yeah. These are generally, so I will say the emotion gets higher as you get closer to needing your portfolio to live on, right?
Well,
so
yes.
If you're 30 and you're like, yeah, I don't like this, but it's money that you're not going to touch for a long time. So there's less emotion there, right? So that's kind of like, hey, you're young. It's going to work out. Just turn it off, stay the course. Don't worry about it, right? But as you get older, the thing that we really like to focus on is like if you're using the portfolio is let's see how much of your portfolio is in safer investments that are not being as affected by this, right?
Okay.
Because that's the money that we need. So if we have 5 years, 7 years, 10 years of money in those safer investments that are, based on our withdrawal rates and how much we need annually, that's the first thing, because then you can say, look, you're protected against this short-term craziness, right? Because most people honestly do realize, I know it's probably short-term. Even though we want to go down that road of run away and I'm scared and, things are bad. If you step back, most people realize, hey, I know it will work itself out. It's just I'm really worried right now about what this looks like.
Mm-hmm.
So if you've got that money that's in safer investments, you're kind of like, okay. Reaffirm that you're okay. This money's there. It's going to provide income for you. And if you give this stuff time, it will work out. The other thing that I always try to, and we've used this before, is like one thing you have to remember is if you sell out after a major drop in the market, now what's your alternative? So likely you're putting it into cash or bonds or something safer, right? Because you don't want to be in the market. If that's the case, do the math on how many years at 2% or 3% or 4% return it's going to take you to get back just to level, right? Yep. And so when you think about that, you're like, oh my goodness, it could take me 10 years. Well, and if you think about it, if you leave it in the market, your chance of recovering that is much, the probability is much higher in a shorter period of time, right?
Right.
And so you're actually being smart by saying, no, you know what, if I lock it in, it's going to take forever. And I'll go all the way back to 2008, which was a super scary time. Financial crisis, banks, like all kinds of issues, right? And we really, helped clients use this kind of methodology to stay invested. And guess what? It worked out great. Well, the Wall Street Journal was running articles of, hey, people can't retire now because they sold out and they didn't get the recovery, and which is awful. It is. It's awful. And
right, it is.
But the thing is that we worked really hard to educate around these ideas that, look, you've got money in safe investments to get you through this. If you sell out, you've got to, it's going to be very difficult to ever get that money back, and just kind of walking through and trying to put logic out there. And then also showing how markets rebound. Like there's all kinds of history about after big declines, how quickly markets rebound, because it's kind of like a bouncy ball, right? The harder you throw it down, like generally the higher it bounces back, because that's the irrationality that you were talking about earlier, because the short term it's irrational.
And I'm sitting here thinking of 2022, which is, that COVID year when everything was just like, oh, the markets just absolutely blew up and nothing worked right. And everything was everything was wrong. And if you look at where we are now versus where we were in the midst of that craziness in 2022, you would really regret having sold out of the market if you had, in fact, sold out of the market at that time.
You're absolutely right. You're absolutely right. And it's interesting, like even looking at returns. So like the last 4 years, which included, basically that 21, I'll call it 21 through 25,
Yeah, sure.
Market still, the S&P still averaged over 8%. I mean, and that involved like a pretty big correction year in 2022, I believe, where it was, where we had the interest rate adjustments and all that. So things work themselves out, even through really bad things that we have to go through. And that's kind of a key takeaway on that.
So stay invested through election cycles.
I think that's a big thing. And one of the things, too, that people ask, and we found this through like some of the research, what's the cost of like reacting, through all these things?
Yeah.
And, like there is a cost, because if you look at all the data that's out there, I mean, typically people that tend to be very reactive to if their person wins or doesn't win and making adjustments to their portfolio.
Right.
I mean, there's estimates out there that annually it ends up costing like 2 to 3%. I mean, that's a huge amount of money, right? A huge amount of money.
Yes.
And so what it does based on political optimism or pessimism, and so when you start factoring that in, and I mean, let's just say, as an example, let's say, you've got somebody that you didn't vote for that's in office for 8 years, right? Now, if you happen to, lose 2 to 3% per year for 8 years, that is a monumental amount of money.
That is huge. Yeah.
And so there is a huge cost, and many times it ends up with somebody having significantly less risk, than they should have because of, really making those changes just because they don't really think whoever's in office is going to do a good job, and it's going to cause problems with stocks. So it's a really good lesson. It really is.
Yeah, it is a hard lesson, which is easier heard than it is put into practice, because they are short-term things can be really super emotional. So how do you work with clients and say avoid these major portfolio changes? So they just calm down, take a deep breath, walk around the block. What do you say? I mean, how do you remind them to stay focused?
Yeah, the one thing is you can't just say, hey, you just need to stay disciplined, because people are like, hey, I'm mad right now. I'm scared right now. I don't want to just stay disciplined,
Exactly.
And so the first thing is that, and we strongly believe this, and most certified financial planners will tell you a similar thing, is that number one, your investment plan needs to follow an overall financial plan, right? So like if you're investing willy-nilly, like, oh, I feel good this year, I want to be more in stocks. Oh, I don't feel as good this year, I want to be more in bonds. That's not going to work very well, generally speaking, because markets are erratic. You never know what returns are going to happen in a given year, and you're probably not going to have a great outcome, right? But when you invest based on a plan, like, okay, how much income do we need out of the portfolio? When do we need it? All these things, how they're integrated, and now our portfolio follows that plan. And so like we know, hey, we've set aside money and safer investments to provide income, through a long enough period of time that if markets go crazy, we can let that money sit. And so we're not having to sell things when they're down. We can allow them to rebound, right?
Right.
Because let's say you're super aggressive and you need money and you do have a big decline. Well, guess what? Now you're having to sell things when they're down. And that, everybody knows, is not perfect, right? We would rather avoid that as much as we can. And so that's probably the first thing. And the other thing is, like, I tell everybody, the one thing you got to remember, the news is not your friend. The news is there to help you. Like, they want you to just keep watching, right? So whatever you believe politically, you can find a TV station that matches that, right?
It's not just TV station. Like, well, let's make it really current. It's like you can find an internet channel, you can find an internet website, an internet news site, a TV station. If you want to stay in an echo chamber, boom, the world is made for you to do that.
Yeah, you're not kidding. You're not kidding. And you've been in media a long time, Bill. You know that. Like, you know how it's changed over time and how they now cater to like philosophies or political views and things like that, because they are a for-profit organization, the news channels. They're trying to make money. They're trying to keep people watching so they can sell ads and everything else. And so the more exciting or dramatic they make it, the more they keep people watching. And so what that does is it reinforces either fear or excitement, depending on what side you're at a current time, And so that plays into what we're talking about. So guess what that does? They're like, oh, I have to make a change. Like I need, like if I'm scared and they're scaring me more and more, I got to get out of here. Or the other way is if they're like, hey, everything's going to be great, you may actually go more aggressive. And like I say, that's not necessarily sticking to a plan either. I mean, generally that can hurt you as well if you don't have enough money in safer investments if you need it. So like it goes both ways. But if you can understand that the media is not there to help you do well, they're there to keep you watching. And then you can kind of take that and say, okay, I need to turn this off because it is making me feel really uncomfortable one way or another, and say, hey, I'm going to go do something I enjoy. I'm going to read a book. I'm going to go for a walk. I'm going to see my grandkids. Because what you have to understand is that they're, sensationalizing everything, which is really not how the world works long term. Most people are kind of moderate. Most what I want to say, through time, civilizations have tried to move forward and do good things, and it's not to destroy themselves, right? And so overall, good does overtake bad over long periods of time because it's better for everyone.
Yeah. It's like that's market averages, right? Yes, short term things can be extraordinarily volatile. Things can be a little bit crazy, but over time, when you look at market returns, they are consistently higher long term. Same thing, with civilizations and with cultures. We always revert to the mean.
Yeah.
Everything reverts to that mean at some point. But living through the craziness is still living through the craziness.
It is. And it's like everybody, the most common statement you'll hear, especially with investing, and it can be with other things too, but this time's different. Like everybody, they know, hey, it's always done this, it's always done that, but this time's different. If that's probably the most common phrase you'll hear when people are really feeling anxious and scared. And the reality, nobody knows the future. Maybe this time is different, but if everything hits the fan and it's like, does it really matter what investments you're in? I mean, if it's really the end of the world, it's not going to make too much difference, right? But
if it's Armageddon, your portfolio is really not going to matter much at all, is it?
You want someone that's going to help you have long-term success, help you stay the course through these things, stick to your plan. Because I've been doing this a long time, and I will tell you, sticking to the plan works. I mean, we've been through all kinds of good and bad markets, through the last 25 years, and sticking to the plan works. Diversification, making sure you have a good balance between stocks and fixed income and things making sure you make good decisions with Social Security and good decisions if you have a pension, and just really thinking things through and not doing it emotionally. It works. Guess what? There's no perfect solution, but if you do those things, generally speaking, you're going to have a pretty good outcome.
True. History is on the side of that statement, as a matter of fact. So, Dan, if people are listening to this podcast and are thinking maybe you're the guy they want to have that conversation with, what is the best way for them to reach out to you and at least have an initial conversation to see if you're a good fit?
Yeah, I mean, first of all, always check out our website. We've got just a ton of great information on our blog area, Insights tab, where we've got a lot of things. If you just want to start learning more about these things, because a lot of times maybe you don't have as much, and America doesn't educate people that well around finance, unfortunately. And so we don't always get a lot of exposure to a lot of these ideas and topics. So we've got really good articles, checklists, all different things that really can help you start to maybe understand it better, right? Which is the first step of getting better at money. And then you can always reach out through our website. There's a typical contact us, just like you see on a lot of websites, where it'll send an email over and we'll reach out and give you a call. You can always call our office. Again, that contact information's on the website, but it's 517-783-1695. You can always give us a call. We'll be happy to set you up with one of our certified financial planners and have an initial call. And just even if you have questions you want answered, doesn't have to be some big formal thing. But we would love people to get good information so that they can make good decisions. The world's not slowing down. The world's not getting simpler. The media is not slowing down either. And so having other resources to kind of step back and look at this more objectively, I think can be really powerful. One of the things that, you have to remember is that, Your portfolio doesn't care who the president is. You know what I mean? That's the thing. Like, it doesn't know, right? It cares about how disciplined and how much you stick to a plan. We're always going to have anxious times. Everybody, we're human beings, right? Sure. But having that, resource, that advocate that's on your side that really wants to see you have success. I mean, I don't know if you can put a price tag on it, but it's just so important.
No, you can't. Now, I know that the contact information and the website are in the show notes, but just give the website so that people can hear it and they can go look it up later if they don't remember it.
Yep. It's pretty straightforward. It's just AveryWealth.com. And when you think of Avery, just like the labels, that's what I think of the Avery labels, easy to remember how that's spelled. And then wealth, the word WEALTH.com. So if you go to AveryWealth.com, all those resources are there, all of our contact information. And I highly recommend it. Lots of good stuff.
The other thing you can do if you're listening to this podcast for the first time and are not a subscriber is become a subscriber. That part's really easy. All you have to do is hit the follow button, hit subscribe. The beauty of that, and the reason you want to do that, is that every time Dan drops a new episode of the podcast, you'll be notified and you can give it a listen. And the other thing I would ask is if you find Dan's help or advice or conversations useful, interesting, you like them, tell people about them. Give us a good rating and let people know. Word of mouth promotion is absolutely invaluable in this crazy world where you don't know who is recommending what to anybody. And we would very, very much appreciate it. So until next time, I'm Bill Tucker on behalf of Dan and everybody at Avery Wealth. I want to thank you for taking the time to listen today, and we'll catch you next time. Thank you for listening to Ramp Up Your Retirement. Click the follow button to be notified when new episodes become available. Visit our website at www.averywealth.com or give us a call at 517-783-1695. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Avery Wealth. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. The opinions voiced in Ramp Up to Retirement with Dan Reese are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on the show may not be affiliated with CWM LLC. Views and comments by guests may not be representative of CWM LLC. Investment advisory services are offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.